Hello, and welcome back to another episode of The Responsibility of Investing from the PRI. My name's Tamsin Ballard, and I'm Chief Investor Initiatives Officer here at the PRI. And it's a pleasure to welcome you to another episode where we'll be focusing on COP30, where the dust has just settled, and after a busy few weeks in Brazil, now feels like the right moment to take stock of what and wasn't achieved, and to zoom out a little bit on what it all means for investors. Now, I've been involved in several COPs, both in my time working in the UK government and here in my role at the PRI. And this one didn't feel like business as usual. So I participated in the first week in Belém, and it felt like a step change for investor engagement. And this was a year where investors were very much at the heart of the discussion. Now, that momentum began in São Paulo at PRI in person, which was part of the COP30 Business and Finance Forum, and the timing couldn't have been better. We saw really strong participation from the Brazilian government and the COP30 presidency, over 1,000 investors in the room, and really serious conversations on investable opportunities across mitigation, resilience, and nature. And it really reinforced the point we've made for some time. The action agenda and all the delivery-focused initiatives at COP are really where the rubber hits the road. And it's all about implementation. And investors, businesses, other non-state actors have a really pivotal role to play. And we saw this especially on the critical question of scaling finance to emerging markets and developing economies, where there's enormous opportunity in the net zero transition, and where detailed work's being done to engage with investors as part of the Baku to Belém roadmap that was led by the Brazilian and Azerbaijan presidencies. We'll say more on that a bit later. Now, after PR in person, it was great to see that focus on delivery carried through to Belém for COP30. And, conversations were sharper, more grounded in the realities of financing the transition. And we saw real movement on innovative financing mechanisms, renewed attention on quality of NDCs, and a really clear recognition of the climate-nature nexus. And overall, a sense that the era of pledges is very much giving way to the harder but very necessary work of making action investable. So what matters most for investors, and where do we go next? And I'm delighted that we've got two guests who can really help us to unpack all of that. So Jan Rasmussen, Head of ESG and Sustainability at PensionDanmark, and a member of the Net Zero Asset Owners Alliance steering group, who was on the ground in Belém alongside other members of the Asset Owners Alliance. And Daniel Gallagher, PRI Senior Lead on Climate, who was also on the ground in São Paulo with the investment community in the week prior to COP30. So let's dive in. Daniel, if I can maybe turn to you first. Now, as I mentioned, PRI used the opportunity of hosting PRI in person in São Paulo just days before COP30 to really try and help ensure the voices of responsible investors were heard by the global policymakers. Now, you were there engaging with the international investor and business community. Can you just reflect on what you saw as the value of bringing stakeholders together in that way, and any key signals that you heard from the investment community on what really needs to happen next in terms of investment in the transition?
Sure, Tamsin. Great to be here with you and Jan. So I think, look, in Brazil, it was clear that the presidency wanted to move beyond the era of these big voluntary pledges that we might think back to what categorized COP21 in Glasgow, in my hometown, a few years ago, to really move into the era of implementation. So what stood out to me was the connectivity that the Brazilian presidency drew between what the COP text says and what the negotiation space is, and the real economy that's in transition now, and what that needs to look like in the years to come. So this action agenda that they positioned as the bridge between the negotiation space and the real economy, I think was an interesting innovation this year. And I think Brazil recognized a couple of things. They recognized that the formal processes around COP, after 3 decades of efforts and incremental progress, it's not going to deliver the scale or the speed of the transition alone, right? So current policies put us on a pathway that's still risky, still puts us into the unknown on climate, and a lot needs to be done there. But that this parallel process could really focus on understanding what's going on in the real economy and examining how to accelerate that, right? So that's what the action agenda was. And on the ground in Sao Paulo, we saw the seeds that had been planted in the months prior at London Climate Action Week, at New York Climate Week, we saw that really come together with the sort of energy of business and the investment community to sort of amplify the real progress that is happening. So I think for us at PRI, when we were on the ground at PRI in person, we were foregrounding with the investment community some of the major progress in investment flows in the transition. We know now, it's well documented, that more than $2 trillion were invested in the real economy last year in clean energy, double that of fossil fuels. But if you look behind the headlines, despite those record-breaking investments, you do see a sort of misalignment between where the money is flowing and where it's most needed, right? So some sectors are underfunded and emerging markets very much are underfunded as well. But if you look again at the work by institutional investors, it's clear that 80% of those investors now have processes to assess climate risk. We see in the community of asset owners that PRI supports through initiatives, more than $700 billion have been allocated to climate solutions now as well. So I think there was a clear signal in São Paulo that these institutional investors are eager to fund the transition, but really need support from policymakers. There's a lot of evidence now across different levers that investors have tested since COP26 in Glasgow. But it's about, I think, how those efforts can be accelerated through a wider sort of examination of the system, the policymakers, the connection with the real economy. So that's what stood out to me.
Brilliant. Thanks, Daniel. So take from that, very much investors are still at the table, very much so, but also kind of that value of the interconnectedness between investors with policymakers, et cetera, to move things forward.
I would say yes. I would say investors remain at the table, and increasingly they're being asked by governments and by multilateral development banks, what is it that you need to invest with confidence in the transition? So that's an important question, and it's good those conversations are happening.
Yeah, absolutely. And so progress being made there in terms of getting that dialogue going between policymakers and investors as well. Thank you. So yeah, maybe if I can turn to you now. Now, PRI had a delegation on the ground in Belém, and we were pleased to see so many investors there too, more than I was expecting. So just from a PRI perspective, I think we had over 40 of our signatories attending, for example. Can you just say a little bit about why you, as an institutional investor, felt it was important to be there and what your hopes were going into COP30?
Building on what Daniel just said, I think for us, the main reason was to meet people from governments, not only politicians, but also civil servants, government officials, other investors, and even NGOs. So to meet a lot of people, countries, delegations, organizations, also other investors, that is a huge opportunity at the COP, and that was the main reason that we came there. So you could say to meet, to inspire, and to be inspired, tell about what we do ourselves, share experiences with the like-minded investors, but also to engage both bilateral and in collaboration with our peers in the industry, with all the players that we have to collaborate with to make this successful. So meet and inspire, get inspired. That was our hopes, and I think also with the assistance of PRI, I think we were quite successful in achieving that main goal.
Great, thank you. So very much got that networking, collaboration, learning opportunities. It's such a huge forum, isn't it? I think it was over about 70,000 people attended in Belém, and as you say, from a very wide range of stakeholders there. So it's a great opportunity. And how was your actual experience then on the ground of engaging with those stakeholders and policymakers? And how do you feel the investor perspective landed in Belém?
I think there was a huge interest for listening to investors. I think it started actually in Dubai, and it only grew in Baku, but at Belém it was this interest was higher than ever. Partly driven by the Brazilian presidency, we had a several interventions already in São Paulo, by the way, with the Brazilian Ministry of Finance and Economic Affairs. So we really felt that the world community, so to speak, were driving to action mode, and they wanted to know what we need to participate more. I certainly think that it's true also, echoing what Daniel said before, that there is an appetite for the responsible investor community to invest in climate mitigation and probably also in resilience and adaptation at an unseen scale. But some of this potential will not be reached if politicians and governments do not make the necessary steps forward. So that's where the interaction needs to come, and that's also why I think it's important to be there in person, because the concrete dialogues that you can have in person are more intensive and then give more learning, and the outcome will always be better than if you're not there in person. So I think we had very good interchanges with a lot of people and organizations there.
And interesting, just picking up one of the points you were saying about discussing with the meetings that you had with the Brazilian Ministry of Finance. I think that was one of the things I really noticed with this COP as well. The greater involvement of finance ministries actually across the world. Yeah, if we think about the work of the circular finance ministers, for example, on feeding into the Untitled Belém roadmap on how do you mobilize climate finance to emerging markets and developing economies. And as you said, Jan, we certainly saw a lot of involvement and leadership coming from the Ministry of Finance from Brazil, which was great to see. Yeah, maybe if I can just stay with you and just thinking a little bit more then on some of the outcomes from COP. And maybe the first one just to touch on, as I was just referencing it, on emerging markets and developing economies. And we saw at COP30 and indeed in the road to COP30, lots of efforts around increasing flows to finance the transition in those economies, including, as I mentioned, the Untitled Belém roadmap, the Tropical Forest Forever facility, and that continued push on multilateral development bank and financial architecture reform. Now, from your perspective, what did you see in Belém that you think has promise on how do you really close that financing gap to emerging markets and developing economies?
Well, the first we have already touched upon. It is the growing interest from Ministry of Finance and economic ministries around the world. We didn't only speak with the Brazilian Ministry of Finance. We also talked with other representatives from other countries, economic ministries or finance ministries. I think that is a very, very important progress. And the other one is that there is a willing to continue the reform of the MDBs, which is very important when you look at financing climate solutions and scaling climate solutions to the global south, because there is a scope for improvement in the way that the catalytic capital works through this system. And we even had discussions with International Development Bank, IDB, where their top leaders themselves said that they were willing to reform further. And I think it's a task for the global politicians in the near future to make the final reform so that we can see the MDBs, the multilateral development banks, the DFIs, and all other providers of catalytic concessional capital being able to have more effect on climate investing in the global south. And I think we made quite clear in those discussions, engagements with these parties, that what is needed is more, let's say, real de-risking. And that means that there needs to be a stronger focus on providing equity as concessional capital. We talked, it's not only about the quantity of concessional capital, it's also about the quality of concessional capital to have the max impact that we want. And here, a broader focus on equity is part of the solution. And we also had discussions of how to make currency hedges mechanism for that more efficient than they are today. And I think it was interesting that the leaders from DMDBs themselves said that they were actually they shared some of the same thoughts and considerations that we as private investors do. And that may scope for some optimism going forward, I think.
Great, thanks. I think as you just described, some of the things that I certainly saw as well coming out from Belém is, the conversation's going a lot more specific. So kind of rather than the high level, we need to be coming together, we need action on mobilizing capital. But as you say, kind of, well, actually, what kind of capital, and is it debt or is it equity? And I think that's the stage we really need to be at now in terms of what are the specific responses that and solutions, and how do you co-create those as well with the right partners around the table. Now, if you had to point to one specific reform that you feel would help to unlock that long-term capital at the scale that's required into emerging markets and developing economies, what would it be?
Larger focus on providing equity and real risk capital to have a better quality of the concessional capital that maximizes impact will be a very important step forward. I must say that one conversation we didn't have as much as I had hoped was with other climate-friendly investors, because we also need to have discussions in our investor community ourselves about how we perceive risk with investments in the global south, in the high growth economies in the global south. Because it's our experience in PensionDanmark and through the funds that we invest in that finance development of renewable energy in countries like India, South Africa, Chile, and with pipelines in many other countries, there are probably a lower risk than is perceived at the moment among many investors. One has to recognize that these are economies and markets where the growth is much higher than it is in Europe or even US and certainly in Japan. And that means that the ability to pay and fulfill obligations is quite good, actually, in these markets. So that's also something that has to be overcome. And I think that will be a discussion that will continue in the coming years between ourselves as climate-friendly investors. Maybe one final point is that when we look at developing renewable energy in the high-growth markets, it's also important that these countries understand that when private investors come from the richer part of the world, they still need, because they in fact are private investors investing for other people's money, they need to have a satisfactory return on their investments. So the economic conditions for developers and those who finance the developments of renewable energy, they also have to be satisfying, and that's not always the case in these markets. But our experience is in really many countries, you can make good business at the same time that you're scaling climate solutions to the global south.
Great, thanks. And there's so much to unpack there, but that point around the perceived versus the real risk, and I think there's lots of discussions around how do you get better data out there, etc. But actually, your point that also you need to get some better conversations going, and back to what you were saying earlier about the importance of learning between different investors as well, and those who've got the experience on investing and seeing the returns coming from those investments. So really interesting. Thank you. Daniel, if I can maybe turn to you. Now, you are following the COP30 negotiations from the UK. From your perspective, what did you see? Did it look like a success or not?
You have to look at it from a couple of different levels. There is, after 2 weeks or so, there's the formally negotiated outcome, which is a text we can look at. It contains what ultimately the consensus was between all 190 plus countries on finance, technology, just transition, ambition levels, and so on. But there's also beyond that, there are signals as to where we are at this moment in time in the real economy on the transition. So you can look at both at this moment in time. I think on the formal side, it's clear that many countries pushed for much, much stronger outcomes and a more ambitious overall package on finance, on ambition, on national transition plans, NDCs. And so the final text there and national pledges don't solve the climate crisis. They still leave us well above 2 degrees of warming this century. That's dangerous. That's potentially catastrophic, depending on how bad tipping points get in the climate system. What we know is that it locks in worse physical risks, and it means potentially more abrupt changes ahead in the transition when, as we believe, ultimately the response does come to prevent that kind of catastrophic climate outcome. So that's the formal side. But I think the spirit of the Brazilian presidency in their collective joint efforts shows that multilateralism still has life in these very challenging times of geopolitical friction. So we see more than 190 countries restating their commitment to the Paris Agreement, showing the persistence of that process. It's an inadequate process that most certainly could be reformed, but we do need global cooperation to continue, and it is continuing. As Jan has suggested, you're seeing a stronger dialogue between investors, multilateral development banks, policymakers advancing on solutions, including on emerging markets finance as well. So I think we see this from PRI's perspective in the conversations that we're part of, quite frank discussions between the investment community, the Brazilian government, the COP presidency, on really overcoming the barriers that mean that only 15% of investment flows to the transition right now go to emerging markets outside of China. That's a problem. So it's a problem from a risk perspective that so little finance is going to where it's needed if you ultimately are to have a global transition. At the same time, Jan, you've highlighted finance ministries were involved through the Circle of Finance Ministers. That's very promising. That's more visible. I think that's quite consequential, and I hope that we see more of that in COPs in the future. Looking back a few months prior, Tamsin, we also see that these national transition plans, NDCs, are higher quality. So depending on when you count the cutoff point, you have between 60 and 100 NDCs now submitted by countries. It's not enough. Many missed their deadlines, but the investability of NDCs, if you will, the quality of those and the information that they contain there provides investors with stronger policy signals. It demonstrates where you have, through enabling policy environments, ultimately the details, the sector plans, the investment plans that you would need to have confidence to allocate. So I would say for investors, the formal outcome does not match the science. It doesn't solve the climate crisis. It does contain some interesting things on adaptation finance, which there's a commitment there to tripling. There's some stuff there about closing the gap through a global accelerator. There's some details that we ought to examine there in the text. But I would say more broadly and more importantly, the direction of travel in the real economy is still pointing towards a faster transition in many economies, not all. And so we're entering this period now of a multi-speed transition playing out. So I would say for investors then, if you judge this moment just by the text, you'll be disappointed. But if you judge it by how many countries are progressing on their ambition and their implementation of policy and their attraction of finance to implement their national transitions, then we see a more nuanced picture and we see things that matter to the investment perspective that allow more informed decision making. My own hope is that the politics catch up with the economics, right? So the economics on the transition are clearly moving. What we see historically, here in the UK on coal, for instance, is that ultimately, after the economics are clear, the politics catches up. And when you have a synergy, then you have the phase out of the technology of the past and an embracing of the technology of the future. But there's a lot of play that's worth following for investors in where we are in the moment on the transition, what the signals are beyond the decisions text itself.
Brilliant. Thanks, Daniel. So directional travel, very clear, but politics and somewhat of a catch up at the moment on this.
That's fair.
Yeah, maybe if I can just turn to you and any reflections you've got, and maybe in particular around the lots of discussions around the fossil fuel phase out. You'll recall that at this COP, we saw the Brazilian presidency seeking to build up on that COP28 decision that we were discussing before in Dubai 2 years ago that mentioned the fossil fuel phase out. Now, we had more than 80 countries in the second week of this COP expressing support for that clear roadmap on fossil fuel phase out, but it didn't ultimately make it into the final COP30 decision. That need to play catch up, as Daniel was talking about. But the Brazilian presidency have said they'll carry this forward in the G20 and elsewhere. What signals do you take away from COP30 about the nature of the transition away from fossil fuels that we know that investors need to be pricing into portfolios?
I think that Daniel made a very good overview of the perspectives from COP30 that I fully agree with. More specifically, I think the COP ended to have a weak reference to the paragraph in COP28 in Dubai, where the mentioning of fossil fuels phase out stands. So it's, although indirectly, it's certainly still in the mix also at the political level. But the signals to investors with respect to fossil phase out have, of course, been too weak and disappointing. So we have to look at the real economy instead to get the signals. And the signals are quite good here. I think the technology improvements, the constant technology improvements into clean, low-carbon energy are so huge that they will dominate how investors perceive the future. It's simply economics and technology that will give the signals in the near future. Low cost, new possibilities and opportunities will make countries and indeed private access companies to invest in the green transition. So I'm quite confident that it will happen. Still not at the speed that one might hope for, but I think that we had just before the COP, there was, I cannot remember who made the calculation, but I think it was the investments globally in renewable energy were twice the investments in fossil energy already now. So we are moving in the right direction, and I think this difference will only rise in the future, and that is what investors should put emphasis on, and not so much on disappointing, weak political signals. The hard evidence in the metal industry, so to speak, is that clean energy, low carbon energy will indeed be cheaper and will crowd out fossil fuels.
If I can build on that, Jan, I think there's some really good analysis came out for Brazil from the Bloomberg New Energy Finance, as well as the Climate Policy Institute, who track real economy deals, essentially. And that's what points to the global investment in clean energy being double what we see in fossil fuel investment. Ultimately, looking further back, solar costs came down 99% in costs since the 1970s, when several countries in Europe began to see renewables as an alternative to oil dependency and oil shocks, right? But even since 2010, those prices have come down 80%. So if you reckon with solar now being the cheapest energy source in history, as you say, it's in the money, the economics are there. What we revealed in our work in the COP30 briefing we did was that it's a problem that only 15% of those investment flows globally are going to emerging markets outside of China. And that if you look at the independent high-level expert group on finance, you need to see, I think we calculated a 7-fold increase in flows to emerging markets by the 2030s. Obviously, if we don't do that, then global emissions stay high, and that means higher risks to all of us that work within the global financial system and the economy. So it's in everybody's interests that those financial flows scale to emerging markets, and there's some really, really good work there, I think, in the collaborations between governments and investors on ways forward, which I definitely encourage a continued and deeper exploration of.
Great, thank you. So I'm taking from both of you a sense of cautious optimism here in terms of, the economics are quite clear. The transition is underway. We are seeing more collaboration from kind of the right different groups of stakeholders. But back to as we were saying before, kind of the politics are lagging still. And so that's what we need to see accelerated in order to help to scale and increase the pace at which the transition is happening if we want to really reduce those risks that are very, very evident now. Okay, look, the last thing I just wanted to touch on then was just thinking about, what's next for investor action on climate and transition. And maybe, Daniel, just to start with you. Now, at the opening of COP, the UN Secretary General made it quite clear that the world has failed to keep warming to the 1.5 degree limit, and that we are looking at overshoots now. Going beyond that is going to be an inevitability. Now, you've led on work with a PRI briefing that we issued earlier in the year on that overshoot, about navigating that higher volatility and predictability going into this new era. Now, what do you think that breach of 1.5 degrees, what do you think it means for how we should be thinking about the transition? And in particular, how responsible investors need to think differently given that changing profile of climate risk now?
This is quite a sobering one, and it's really important, Tamsin, I think. So, yeah, you had the UN Secretary General warning at the start of COP, essentially making a departure in UN messaging on climate, saying, look, we've sought for years to retain a focus on limiting warming to 1.5 C, the lower limit of the Paris Agreement. And this new message, informed by the latest science and policy dynamics, is that that's not feasible, right? So in opening COP, then you had the UN warning essentially of these potentially catastrophic tipping points, the amplification of threats to peace and security. And this is in recognition of the fact that NDCs submitted prior to COP put us on track for upwards of 2.5 degrees of warming this century, which really does mean higher financial risk, higher risk to economies, and so on. In Brazil, in São Paulo, we had Professor Tim Linton join us, who coordinated the Global Tipping Points report. I encourage our listeners to check that out, to read that. That discusses how the world is entering this new reality on climate risk in the coming breach of 1.5 C. So it reviews the tipping points on warm water coral reefs, on polar ice sheets, on the Amazon rainforest. I was speaking with a chief scientist earlier this week at an insurance firm in Europe who's tracking as well the Atlantic overturning circulation dynamics as well. The truth is that a full collapse of that important, essential geophysical process, it's not likely this century, right? So we're not going to see perhaps a catastrophic, sudden, abrupt change in Northwest Europe's climate. But there are many other tipping points that are being examined in the climate science community that are at risk and do point to a step change. So what does it all mean? It means that investors grappling with worsening physical risks and the non-linearity of those risks are enhancing their analyses. They're enhancing their assessments of climate risks now and doing more to integrate that, to engage investment teams, investment boards on strategy, on risk management. We issued a briefing in June this year, a PRI briefing. Perhaps we can link that in the show notes. And this is all about how do responsible investors continue to use the agency they have, engage with the transition, and to manage this changing profile of climate risks as we approach and breach 1.5 C. So we firmly believe that responsible investments still have a lot of agency. And in this new reality of risk, it's advantageous to have a good, well-informed, strong understanding of what's going on in the climate system, as well as how one can engage with the transition in this more disruptive, volatile, and unpredictable time. Ultimately, in one sentence, engaging with governments is an essential component of all of this work in these times. That's a key part of responsible stewardship. I think I will highlight, Tamsin, coming out of COP30, you see this effort to triple adaptation finance by the mid-2030s. That's a signal that is clear in our community as well, whereby on resilience, on adaptation, on assessing physical risk and doing something about it, that's now a counterpart priority alongside decarbonisation, mitigation. We're already seeing physical risks materialize in investment portfolios, but also that adaptation has the potential to deliver good returns as well alongside decarbonisation. So I think for responsible investors, it's about looking at the tools that we have as a community, reckoning with and reassessing what's working on capital allocation. There's different solutions now available as opposed to 5 years ago, 3 years ago. So research, analysis, intelligence on the transition, what's unfolding with policy and technology. It's really worthwhile grappling with that. And on these worsening physical risks that can cascade and compound to systems, it's worth improving our integration of those into decision making. As I will always state, engaging with governments where that makes sense for your stewardship as well. Beyond those kind of idiosyncratic risks, governments have a very strong role in setting the playing field, as it were, around zoning, around planning, around building codes, city planning, all the elements that in the real economy will shift real assets and ultimately change the risk profile and make the risks more tolerable for responsible investors.
Great. Thanks, Daniel. There's some really practical things that investors can be thinking about there. Jan, anything you wanted to add to that in terms of what you see as next for institutional investors with that changing profile of climate risks and thinking about climate and transition?
Well, first, it wasn't a surprise that the Secretary General made that statement. It has been underway for a couple of years, I think. When we think about our response, I think we should probably just do more of the same that we're already doing as climate-friendly investors. Now, the target is to limit the overshoot, both in time and in degrees. So let's say maybe a hopeful scenario could be to reach below 2 degrees, 1.9 maximum, and have that overshoot for a few decades, and then return at some time back to something like 1.5. It is indeed possible. It takes a lot of effort, a lot of investments, but it is possible especially if we can work together with the policymakers to achieve that. Then, of course, as a natural consequence of this overshoot, more emphasis will be on resilience and adaptation. Here, I think we need a discussion about, again, the division of labor, because traditionally, I see construction of dikes, for example. It's a public task for the public sector. It's very difficult to make a construction where you get cash flows out of owning a dike. So you have to construct a new form of public-private partnerships if you want to have a huge amount of the adaptation measures financed by the private sector. That's not to say that we will not ourselves invest in adaptation or resilience going forward. We will. But the focus will be to secure and protect our own physical assets. That means our real estate portfolio, our infrastructure portfolio. We will take the necessary measures to ring-fence them when water levels are rising, for more extreme weather conditions will hit them. So that's where I see immediately that there will be a greater concern for us, and also, of course, naturally from the insurance companies, but for the greater adaptation infrastructure projects like the dikes, for example, I meant before. Something new has to happen. And this could also be a discussion at the international level, multinational level, multilateral level, for what should be the division of labor between the multinational development banks, because a lot of the resilience and adaptation measures has to be developed and installed in the global south.
Great, thank you. So I'm hearing from both of you that it's not an either or anymore. It's very much we need to be looking at the mitigation side, and we need to be looking at the adaptation and resilience. But also that we know pretty much we've got the different tools. We know what's required to accelerate the transition. So crack on and get on with it. But also then the urgency of the situation, the urgency of action that's required, which comes back to what we've been discussing around how do you really accelerate this? How do you get the politics to play catch up on the economics on this as well? Great. Jan, Daniel, thank you so much for your time and kind of sharing all of your thoughts and insights. I have one final question for you both, and it's one that we've asked previous guests on our podcast, which is called The Responsibility of Investing. So can I ask you both, what do you think the responsibility is that investors have with regards to sustainability? Jan, can I turn to you first?
Yes, I think it is to be fully aware of the risk and opportunities to invest for a more sustainable, richer, more prosperous, cleaner world that benefits nature, climate, and people and society in general. And I think we touched upon both aspects just before. Climate risk is certainly something we have to be aware of, especially to protect the value of our real assets, but also the opportunities to invest in climate solutions globally and indeed in the global south. I think there are really good opportunities here for climate-friendly investors to both make good and do well financially. I think that is the biggest responsibility for us. But it's also, while we are investors, it is to engage constructively with the companies, the projects, and the fund managers that we are investing in. So also being active throughout the investment period, try to conduct investments as responsible, sustainable as possible.
Right. Thank you, Jan. Daniel?
It's a great question, Tamsin. I think for me, I'll give a personal reflection, which is earlier in my career, in 2008-9, I began to work on climate change as a young engineer. I was working with engineers in the Andes in South America, working on water supply systems. So the kind of challenges we faced were, how do you bring water supply to 200 people in communities in the Andes with challenging geography? All the local engineers knew how to do that, and I was bringing a perspective on how the climate was changing and how we could make that infrastructure more resilient. At the same time, after 6 months of doing all that work, we saw how mining companies and extractive development conflicted with what we were doing at that smaller scale and contaminated the water, caused problems for health and human development. So for me, I became aware of those bigger geopolitical and development forces, ultimately financial flows of power. And so I think for me, it's been a journey to the investment community that I work in now, through the World Bank, through the Massachusetts Institute of Technology, and being in research. I've come to really think about these big capital flows, investment flows, from the perspective of different scales, different systems. I would say that all of us in finance today have a responsibility to understand how finance and power contribute to these unsustainable development models that we live with today, and the potential, the opportunity for finance to do good. I mentioned already that it was finance that contributed alongside policy and technology to bring down the cost of solar 99% since the 1970s. It's remarkable. So finance has an opportunity, a responsibility to really contribute to this largest transformation of the global economy that we're living through the net zero transition, which we hope is playing out in the coming decades, that will contribute to better climate outcomes, better planetary outcomes. I think for me, all of us working in investment, we're not just passengers in this financial system. We have an opportunity to engage with governments, with standard setters, and with others on getting the conditions right for capital to flow to where it can have the best outcomes.
Excellent. Thank you both so much for sharing your thoughts and insights, both on that question, but also for your time today. Really interesting to hear your perspectives on why and how investors are engaging with the UN COP process, why that really matters, but also the perspectives on the outcomes from COP30 and the upsides, the risks, what still needs to happen. Now, if you've enjoyed today's episode and are interested to find out more, do please take a look at the links in our show notes. And we'll include within those the 2 new reports that PRI has recently published on investment flows to the net zero transition and on unlocking and mainstreaming institutional investment flows to emerging markets and developing economies, as well as some of the other articles that Daniel and Jan have mentioned. So thanks again for joining us for this episode, and see you next time.